Good day, ladies and gentlemen, and welcome to the 2021 RCL Foods annual results presentation. All participants will be in a listen-only mode. There will be an opportunity to ask questions later during the webcast. This can be done in two ways. Firstly, you can submit questions on the Q&A tab at the bottom of your screen during the presentation, which will be answered during our Q&A portion of this webcast. Secondly, if you would like to ask a live question, kindly raise your hand and your name will be called out to ask your question. When you have been unmuted, please state your name, your company's name, and who the question is directed to. Please note this call is being recorded. I would now like to hand over to Miles Daly.
Good morning, everyone, and welcome to our results presentation. If you could move to slide 4, I'll start there. And as in the past, we'll take you through a high-level overview from myself. Rob will take us through the financials, and then the three MDs will take you through their respective areas of responsibility. I think we're really pleased with the result this year, despite the very difficult trading conditions which have been in play for at least the last 18 months. You know, we've had COVID on top of all of that. We have a meaningful improvement in our statutory and underlying earnings, and as you'll see during the course of the presentation, we've had an excellent performance in sugar, in fact, a record performance, and the baking business continued delivering, and we continued with our strong growth in groceries, so very pleasing. Vector has improved clearly in putting together the two networks, which were hampered a little bit at the end of last year due to COVID, but they've made great progress in that regard, and Chris will pick up on that later. We've also continued with our effective response to COVID-19, prioritizing employee safety, maintaining food supply, which is absolutely critical, supporting our communities and managing cash. It's also been a very rewarding and busy year, as you can see under the heading of future-proofing RCL Foods' portfolio. So we've completed our portfolio review and we've gone into some detail later in the presentation on that, and we've got a clear foundation for our strategic thesis going forward. The standalone chicken division has been established with a dedicated structure. Very excited to say that our Live Kindly Collective Africa JV is now live and gives us a fantastic opportunity to participate in the plant-based alternative market, which is really gaining traction worldwide and in South Africa. As I mentioned, great progress with Vector and cold chain integration, and Chris will pick up on some of the detail there. And we've continued to make significant investments in our branded product portfolio, and you'll see later in the presentation we've made great strides in terms of our market shares. If you can move to slide 5, and really this is just the highlights, and Rob will unpack, and each of the guys will unpack in a bit more detail. But we're now over 31 billion in turnover, so more food to more people more often, shown very clearly in our revenue line, up 14%, and as I mentioned, some good share gains. And our Ebitda at an underlying basis up 45%, but pleasingly also on a statutory basis up a similar number, so 2.4 and 2.5 billion respectively, and that's flowed all the way through to our HEPS, with HEPS at just under 108 cents, and the underlying HEPS at just under 118 cents. I think what is really pleasing is that over the last couple of years, in spite of some very challenging operating environments, we've delivered on Ebitda and cash generation. Our problem is due to accounting adjustments and impairments that hasn't flowed to the bottom line. So it's really great to see the answer flowing all the way from Ebitda through to HEPS. If we move on to slide 6, and I won't go through this in detail because we picked up later in the presentation, but just at the highest level gives you a sense of the Ebitda growth per business unit. Within groceries, coming off a good base, but a fantastic performance in pet food and gaining a lot of traction there, and a lot of good innovation, and still a lot more to come in pet. Milling and baking and speciality had a really solid year, as you can see from the 34% increase in Ebitda. Sugar is a real highlight, and a lot of that is to do with our own efforts, and Paul will unpack that in more detail, so I'll leave that for him. And chicken is the only area where we've continued with our challenges in agric, and Martinez will take you through some of the reasons there and our plans for the future. And as mentioned, Vector up really nicely at just under 300 million, and more to come. If you go to slide 7, so if we look at our key strategic deliverables, I've got a slide on number 1, 2, and 3, so I'll leave those. But the others, number 4, which is scale growth potential in groceries and baking, as I mentioned earlier, continued investment there, strong brands, focusing on the categories that we want to grow, and you'll see more about that later. We've definitely maximized our momentum in sugar, the record profitability, optimized sales mix, agricultural cost efficiency. So really pleased about that. And as I mentioned, the network integration in Vector team have done a really good job. So now I'll take you through points 1, 2, and 3. I've got a slide on each of those. If you go to slide 8, very important to talk about this is our strategic portfolio review, which we announced in November last year. We've been through a rigorous process as a board and as a management team using RMB and Deloitte to assist us in this process. And we have resolved that the separation of the value-added branded foods business, which is groceries and baking, essentially, and we'll refer to that in future as FMCG, from the poultry, sugar, and logistics business will ultimately achieve a better, consistent quality of earnings. We do believe that poultry, sugar, and logistics are great businesses in their own right. We just need to have a look at how we manage them differently. Also, we're absolutely clear that we are going to grow the FMCG component of our business, and that includes acquisition activity, and we are actively engaged in that regard. And so the next phase will be, besides the growth of the FMCG, it will be an optimized path for poultry, sugar, and logistics businesses. But we will do this in a very carefully considered manner over the next 12 to 18 months, and making sure that we don't lose that unique platform that we've created at RCL Foods. And so a lot of good work has taken place, and a lot more to come in this area. So as a board, as I say, we're convinced that this is the right direction to take the business in. If we go to slide 9, we have already achieved the standalone chicken division. We started in January with the new senior leadership team, and in July we had a go live with a dedicated chicken structure. There's still some functions that have been serviced by RCL Foods, but it is a dedicated structure within RCL reporting directly to the CEO. And we'll complete the carve-out as a dedicated separate legal entity in the latter part of next year. And then we would be able to do what we think is appropriate for chicken going forward. So a lot of good work and a lot of hard work took place in that regard. If we go to slide 10, really excited to say that we have finalized our JV with Live Kindly Collective for Africa. As you know, plant-based protein is a key strategic investment focus and something that we're really pleased to now have an opportunity to grow. Our joint venture went live in May 2021, and it's a really great joint venture in that Live Kindly Collective brings their brands, their technology and intellectual property. We already own fries. They've got the Oomph brand, they've got light meat, and they're making a number of acquisitions worldwide. We will have access to all of those. And then clearly RCL brings its go-to-market capability, the integrated service platform and customer relationships. So very, very exciting JV. If you go to slide 11, just want to touch on a few other things. That is doing business sustainably. That's critical for the long-term future of the business. And digital transformation is embedded as a mindset that's core to our strategy. And just to highlight one example, we've got our Let's Talk app, an ability to connect meaningfully with 13,000 of our employees already, and that's been working exceptionally well. We've done a lot of work in electricity generation. As you can see, we've supplied 160 gigawatts, including sugar cogeneration and our waste to value and rooftop solar. Our waste to value electricity generation increased 182%. The first phase of commissioning of the new Rustenburg waste to value plant. As you know, our Worcester one has been up and running successfully for some time now. And I think very importantly, is our Do More Foundation has done fantastic work over the course of this last year. And we provided 10.5 million meals to vulnerable communities and contributed directly to youth enterprise development in a number of ways. We continue to provide food and support ECD centers, and we've managed to get funding now from third parties, which is about 50% of the funding of the Do More Foundation. So it's gained a lot of traction and a lot of credibility. So very pleased to report what we're doing in that area. I'll now hand over to Rob, our Chief Financial Officer. Thank you.
Thank you, Miles, and good morning to everybody. Miles has given the results headlines, so I will merely add some color to certain key aspects. So I'm going to start on slide 14, which is the Ebitda Waterfall. And really just to highlight the elements that we've stripped out of our underlying results. This year is really only about COVID, and you can see that absolute impact this year was meaningfully less than the prior year impact. And that trend continues in the business, and obviously there will continue to be some level of direct costs associated with COVID into the future, but it is a smaller number than the prior year. So this waterfall gives you an opportunity to look at our results and where the contributions are coming from in terms of that very meaningful uplift of EBITDA of 45 to 47%. Moving on to slide 15, this merely reconciles then that EBITDA answer through to headline earnings and underlying headline earnings. The only things I'd like to highlight on this, and although it's a small number, it's a meaningful point in terms of if you look at the reduction in the minority interest add back. The important see-through of that is that it demonstrates that there's an improvement in the underlying sugar community-based joint ventures that we have, and their underlying profits have improved by virtue of a significant number of interventions in that part of the business, but that is underlying good news. And then this chart obviously translates all the way through to the 171% uplift in our underlying headline earnings. Clearly a good answer. Slide 16 is merely the unadjusted view, just to be complete in terms of the picture of our revenue and EBITDA. So I'll move straight on to slide 17, which then picks up those underlying adjustments to show a better view of the performance of the business units. And really the most significant numbers that change by virtue of that COVID impact on this slide is the chicken line, that is the entity, and Martinez will share some detail there in terms of that's been most impacted by COVID. And then the other number, obviously, that changes in this chart is Vector's prior year reference by the inclusion of the gain on bargain purchase that was a feature of their results last year. So underlying results are meaningfully up, delivering a margin of 8% overall. But you can see in terms of the stack up there, chicken's low contribution of 1% meaningfully drags that number down from a group perspective, and that number would otherwise be in excess of 11% were chicken excluded. Moving on to slide 18, the cash flow reference, and so despite the impact of the pandemic and the economic environment that Miles alluded to, we sit with a very healthy cash position. So that's a pleasing picture for us to present. The movements within that cash balance during the course of this year had a very significant working capital shift, and it's better for me to explain that on a subsequent slide. And secondly, on this chart is just a shift that you will notice in terms of our Capex expenditure, replacement being a higher feature and component of that relative to expansion Capex. And that really is just a feature of the trailing past couple of years when a number of our sectors were under immense pressure. And then obviously with our cash focus during COVID and the uncertainty associated with that, meant that we were very prudent in our spend. What's happened in this year is there's been a catch-up, so a shift in terms of the weighting between replacement and expansion Capex. And I'll also talk to that a bit further on a subsequent slide. But a pleasing free cash flow generation in the business, and obviously a very pleasing end balance that we were able to report. Slide 19 then unpacks the working capital analysis, and the headline has to be a takeout that our working capital remains well managed. This chart shows that although we've had a 25% uplift in the value of our working capital, our net working capital, and that's shown as a 1% uplift of revenue, we know that these balances, by virtue of the underlying businesses, are an acceptable reference in terms of each of the operations. The more significant feature impacting these values this year was again cut-off, and we do explain it on this chart in terms of this year. Because we use a retail calendar, cut-off was as late as the 4th of July. versus last year's 28th of June. Another way to look at that is that it effectively translated to a very clean cutoff and representation of our, call it also underlying working capital within the business. By virtue of the lateness of it, meant we got almost all of the debtors' money in and paid away all of the creditors' money. So those are the balances that you see most significantly different from the prior year's report. But the see-through is always what is your quality of your underlying debtors book, and that we do show on this in terms of that adjusted analysis, and absolute days are in very favorable territory. Moving on to slide 20, it's just further detail on the Capex, and there's very few significant items, or individually significant items here. I've spoken to the shift between expansion and replacement Capex. So the only other thing I'd like to highlight on this, which my colleagues will pick up on, is in terms of our capital commitments, you'll see the bulk of it there being represented under baking, which is the investment we're playing out in our baking footprint and assets. And then secondly, in Vector, which is the completion of the consolidation of the Imperial networks and the remaining work that's being done in terms of the investment in the coastal facilities, as well as obviously new fleet to support that. Slide 21 is how everything comes together in terms of a view of our returns. We use the return on invested capital as our reference consistently. And obviously a very pleasing picture to present. Meaningful improvement both in the reported as well as the underlying. The underlying references not only pick up the earlier underlying adjustments that I referred to, but also seeks to remove distortions that are inherent in our numbers by virtue of impairments and the intangibles associated with purchase price accounting that is required. So it really does give you a better and alternative lens to how our returns are faring. And there you can see from a group perspective, obviously up at 12.3, but obviously compromised by chicken, as well as Vector's absolutely low number, but on a recovery path, but obviously nothing short of stellar performance coming out of the food division. Slide 22 just really gives you a perspective of where our debt package is sitting. We're moving into the latter stages of that 5-year package. So we're in year 3 now. The only thing to highlight is we've got a small portion of bullet payment that will need to be made during the course of this financial year. It's that 110 odd million. But a pleasing finance cost picture to be able to show out here. Obviously, rates themselves are lower, although on a portion of the package we have a collar in place, so we're at the floor of that collar. But I would also offer that our good working capital management is contributing to a lower interest cost in the business. And I won't dwell on slide 23, but it's just affirmation that our debt covenants are well in hand. And a pleasing picture to support a strong balance sheet to take us forward. Thank you, and I'd like to hand over to Paul.
Thanks, Rob, and morning, everybody. The food division delivered a strong set of results for the F21 fiscal year, with slide 25 highlighting the exceptional performance across all business units. Whilst the Ebitda growth of 58% at a statutory level, the underlying performance in the upcoming slides is not too dissimilar at 53%. If you turn to slide 26, we have highlighted some of our wins for the period. Most of these arise from a clear and focused strategy with heightened emphasis on managing costs and price in a tough operational and very competitive trading environment. In light of that, here are a couple of specific points that are worth calling out. COVID risk continues to be well managed in terms of both employee safety as well as minimizing disruption on our operations. Strong volume performance and market share gains are evident across most categories within grocery. Cost focus across all business units has delivered ahead of the expectation, with sugar supply chain and agricultural costs having reduced substantially versus the prior period. With a solid turnaround in place, we have seen a pleasing improvement in the beverages results, and new innovation in powers has driven good volume recovery in this category in the second half of F21. And finally, within our baking business is well positioned for growth. A sizable investment has been approved and a growth roadmap clearly outlined. Before moving on to the business units, it is worth noting that each landing page will reconcile the results to the underlying performance, including adjustment for direct costs associated with managing COVID over this period. Whilst appropriate safety measures have remained in place throughout F21 to protect staff safety and ensure business interruption is minimized, the impact is fairly immaterial compared to F20. Moving on to slide 28, Groceries underlying EBITDA is 4.9% up on the prior year, primarily driven by a strong grocery result, as well as a factor of higher culinary and pet demand. Improved oil profitability partially offset by margin pressure due to higher commodity prices. Heightened cost focus and volume recovery in both beverages and pies is also contributed to the improved groceries result. Slide 29 talks to the culinary categories within groceries, which has performed ahead of expectation for the period. Despite a competitive trading environment and commodity price pressure, particularly on sunflower seed, which has necessitated price increases, the category has nevertheless demonstrated pleasing profit growth. Furthermore, our Nola brand has continued to grow its market leadership position by more than 1%, despite landing a second price increase in a very competitive environment. Yum Yum's share growth was also pleasing, considering the continued presence of imported peanut butter in the market, which does not attract a tariff, whereas raw peanut imports do. Albeit slow, progress has been made with RTEC in alignment on peanuts and peanut butter tariffs. Focus for the culinary category for the upcoming year will be on delivering operating efficiencies and driving focused pricing strategies in order to mitigate some of the margin risk associated with high commodity prices. Slide 30 highlights a strong performance in the pet food category, which is reflective of our growing market share position across most brands. Within dog food, Optimizer specifically continues to outperform expectation in the co-op channel, with brand revenue now sitting at 175 million only 2 years after it was launched. In addition, strong performance in canine cuisine and bobtail in the retail channel has enabled us to offset some lost dealer-owned brand business, which as a result of a conscious decision made not to chase volume with little or no margin. The cat food category also delivered a particularly pleasing growth, with strong share gains in both feline cuisine and catmore. Whilst we are confident this category will continue to deliver good growth into F22, we need to closely monitor the impact of higher maize prices will have on margins. On slide 31, the pies operating unit has seen a pleasing recovery in volumes on the back of a strong promotional plan, as well as the innovation, more specifically the launch of the Priman's Big Deal Pie, which has exceeded expectation. Leading growth in the pies market through a new innovation will continue to be a key focus area, together with cost-saving initiatives aimed at mitigating margin risk associated with rising input costs. Our beverage business has also seen some recovery in on-the-go consumption, and whilst this has contributed to the improved result, the main reason for the turnaround can be attributed to cost savings arising from the consolidation of the UHT volumes into the fresh plant in March 2021. Moving to slide 33, baking's underlying performance is significantly up on the prior period, underpinned by strong demand resulting from increased in-home consumption in speciality and an overall improvement in operating efficiency. On slide 34, the bread, buns and rolls business delivered a significantly better result, driven by much improved margin across most bakeries, coupled with successful turnaround in operations at the Gauteng bakeries. Volumes more recently have, however, started to slow due to softer category demand and aggressive competitor activity in retail. The business has approved a sizable Capex expansion at the Polokwane bakery and commenced a depot rollout program to chase volumes in areas that Sunbake is currently not found. Moving to slide 35, speciality delivered an exceptionally strong result, driven by increased in-home consumption and boosted by a more favorable mix. Improved efficiency through plant consolidation will be a key strategic focus area that will further step change speciality's results in the next 2 years. The milling performance has also improved considerably over the period, with heightened focus on efficiencies and production reliability driving a more consistent result. Our milling strategic focus, which is to use more of our consistent quality flour internally, remains a big priority for the business in F22 and beyond. Moving to slide 37, sugar has produced a substantially stronger result, driven by continued focus on our own controllables as well as efforts internally to become the most efficient operation in South Africa. Slide 38 unpacks sugar results in more detail. Increased in-home consumption, coupled with a shrinking industry crop, drove a more profitable mix weighted towards local sales. Although our volumes were down on the prior year, RCL benefited from the industry sales redistribution, which is an adjustment based on our production share. Our sugar operation successfully crushed its crop, and as a result, we saw an increase in our percentage share of the industry, which is a key contributor to the improved result. Furthermore, the business units continued heightened focus on cost control in both agriculture and the supply chain were also major drivers behind the significantly improved performance. The double-digit increase in the international sugar price also improved export earnings over the period. Moving to slide 39, good progress was also made in addressing the future sustainability of sugar's 3 cane-growing community-based joint ventures, although work in this area will continue to be a priority in F22. On the Sugar Master Plan, which aims to find a more sustainable solution to local sugar businesses, RCL is actively contributing to implementation efforts. Although task teams are regularly meeting, progress has been slower than expected, and therefore the Competition Commission has granted SASA an extension until 30 June 2023 to enable engagements to continue. On slide 40, Mothertech delivered a relatively stable performance for the year with significant upside seen in the last quarter due to an overall recovery in the animal feed industry, with molasses availability potentially becoming a challenge in F22, driving an improved mix and closely managing costs will become a key focus area. Moving to slide 42, the last slide in the food division section, we have again set out the key areas from a strategic and operational perspective to focus on over the course of the next year. Whilst the division is clear on what is required to deliver on its strategic priorities, operationally, the business will need to closely monitor commodity pricing pressure and the impact it will have on margins and food prices, with the southern consumer already under significant pressure. In light of that, reducing costs will remain a key focus area, and the business will prioritize innovation that delivers value to a cash-strapped consumer. I will now hand over to Martinez.
Right, thanks, Paul. Good day, everyone. Right, so in terms of revenue, one can see a better picture, mostly driven by better pricing and by a return to the QSR business. It was impacted by closure in the first part of the year and in the previous year. In terms of profitability, still not a good picture. Thank you. Right, so underlying Ebitda 50% worse than last year, mostly impacted by the breed challenges, well documented, avian influenza, and obviously very significant raw material input cost driving that result. Moving on to the next slide, more of the reasoning behind that performance. Just want to emphasize in terms of rejuvenating the Rainbow brand, good strides have been made in chilled processed meats, particularly the economy bologna with the Rainbow brand, and also the higher end Simply Chicken brand. Moving on to the next slide. And continuing the trend in terms of input cost pressure, very much matter of raw material and the commodity cycle continuing to rally, and obviously input impacting on input cost. In terms of the Chicken Master Plan, it's very much still a matter of potential that lies within that plan. We are working with government to unlock really the outcome of such a plan, and that is yet to really bear fruit. Imports have declined, but they are still significant. In terms of animal feed, on the EPOL side, again, huge impact because of the commodity pricing side, input cost side, therefore putting pressure on our external volume and obviously on profitability. Just one slide back. Right, so I think this is the most important slide I would like to just spend some time on. In essence, we've made the big decisions. It's now a matter of allowing time to flow through that filter to impact and bring the desired results. So we have built a very strong team in a relative short space in time. We've decentralized the management focus and the way that we manage by giving it a regional focus, which integrates the elements of the value chain so that we can produce the lowest cost chicken of the right size and in the right numbers for the right customers. The onboarding of Cargill has been significant in terms of how we procure maize, given the huge impact of that on cost. If one can do that correctly, you have the battle almost halfway won. We obviously devised a 5-year recovery plan, and as I've said, it's now a matter of allowing these decisions to flow through. In terms of breed, we are very far progressed in terms of interventions to address that issue. It's very significant. It results in a lot of pain down the value chain. We are not self-sufficient within the regions, and obviously the quality of the output from the agri side is hugely affected. We'll continue to sharpen the front end, the customer and the consumer side, maximizing and optimizing the right customer and product mix. And then obviously EPOL is a bit of a sleeping giant, and I'm very encouraged by what we've done, who we have appointed in this regard, and looking forward to a return of a solid performance from the feed business. Mentioned the focus on the brand, that will always continue, and so will the focus on cost and overhead management. Thank you. I'm going to hand over to Chris.
Thanks, Martinus, and good morning, everybody. If we move to slide 52, at the top of the slide, our year is summarized nicely in that pleasing revenue growth and significant progress with the consolidation of duplicated networks delivered an improved performance. As the first bullet point says under headlines, pleasing revenue growth of 21.8% to 3.1 billion, driven by the RCL principles that were taken on in December 2019, and this despite the continued impact of COVID-19 on the food service business. The next bullet point talks to the significant progress we have made in consolidating the duplicated networks post the RCL acquisition, which has enhanced our performance, with the final capacity expansion expected to be completed by March 2022. As can be seen from the chart, pleasing EBITDA improvement and underlying EBITDA margin improving to 9.2 from 4.6 in the prior year. Moving to slide 53, and as I've said earlier, pleasing revenue growth despite continued COVID-19 impact on our food service business. And if you look at the bottom right chart, it shows the new principles taken on in December 19 as a result of our customer line strategy. And the bottom left chart shows the food service and retail customers that Vector represents for their end-to-end frozen supply chain. And this revenue growth in retail helps to mitigate the impact of COVID-19 on our food service business, confirming the benefit of driving our diversified revenue base. Moving to slide 54, and as I've said previously, there's been significant progress made to date in consolidating the acquired RCL network with the Vector network, and we are now busy with phase 3 of the project plan as depicted in the charts at the bottom of the page. Despite delays due to COVID-19 impacts, we expect to be completed by March 2022. With the final synergized network, once bedded down, will continue to unlock synergies and build a sustainable model into the future. Turning to page 55, we see Vector Logistics going beyond, which is Vector's brand positioning, with the pillars of innovation and collaboration as our focus. The first bullet point talks to innovation and our continued journey of digital transformation with the introduction of an online ordering portal and Vicky the Vector bot to improve our customer service and experience. Further to this journey, we have also introduced the use of artificial intelligence to automate repetitive tasks, particularly in the finance area. In the next bullet point, although our joint venture partners Food Logistics in Botswana and LNA Logistics in Zambia have been impacted by COVID-19, they continue to drive positive contribution to our business and enhance our reach into Africa. Further to this, we have increased our shareholding in LNA Logistics to a controlling share of 85% from February 2021, and we are excited at the future prospects of this business. In closing, and as I've said a couple of times already, once our final synergized network is bedded down, we will have a sustainable model into the future, and on this basis, we remain positive in our outlook, despite the impact of the continued pandemic and the customer store closures due to the recent civil unrest. Thank you, and with that, I hand back to Miles.
Thanks, Chris. And if we go to slide 57, which is the prospects, certainly the pandemic and the impact of social unrest is putting a strain on the economy. But what I am pleased to report is that RCL Foods has got into real rhythm and managing to operate through these difficult environments. And I think that's good news for the future, but we mustn't underestimate the impact of this on consumers and the economy generally. Clearly, you've heard about the commodity price rally, and that's something we're going to have to navigate through, but adding further pressure again to the constrained consumer. As you've seen, our groceries and baking business is incredibly well positioned, got a strong focus and innovation pipeline with lots of growth aspirations. And I really believe the team have built a lot of momentum there, and we'll continue to see gains in that area. And as Paul touched on, with sugar, we really have focused on the controllable factors, and we will continue to do that during the course of the next few years. So we're very comfortable about where our sugar business is. And we have the new chicken management team in place. And as Martinez has said to you, we will look at accelerating those cost savings and growth initiatives. And we've got a dedicated team with a regional model. And so we're looking forward to that being resolved. And as Martinez also mentioned, we have some clear plans in what we're going to do next with the breed. And as Chris has touched on, the network is largely integrated now. It's been a great work, and we'll unlock additional margins in that regard, because obviously there's a lot of cost associated with the integration. And I think that we really are moving into the next phase now in building a sustainable, consistent quality of earnings. And probably a very important part of that is the appointment of Paul as CEO designate, and Paul will take over from me on the 1st of December. And I must say it's a very popular choice, and he has a long history in RCL. He's worked in many parts of the businesses, and we're very comfortable. And I'm certainly grateful to be able to hand over from my tenure of the last 18 years to Paul. So Paul, all the best to you. Really look forward to you continuing off this great set of results. So on that, I'm going to hand over now for questions. Thank you very much.
Thank you, Miles. Just a reminder, please, to either kindly submit your questions on our Q&A tab, or if you would like to ask a question live, kindly raise your hand and your name will be called out before we unmute you. Please, a reminder, state your company name, who the question is directed to, followed by your question. We have a question from LB Saliers. We're going to unmute you now.
Hello, can you hear me?
We can.
Yes, we can.
Hi, thanks. No, congrats on a significant better set of results. It's encouraging. I look forward to the separation of the poultry and sugar and logistics entities. Can you firstly, I'll ask a series of questions and you can answer them one by one. Do you foresee a certain time period these will be separated out, and by separation, do you foresee a separate listing? for each of them? That's the one question. My next question is regarding the recurring nature of COVID and other costs, which, I guess falls in the adjusted portion of your earnings. Do you ever foresee a scenario where you have no adjusted earnings or no, none of these costs deducted from your results? I saw an interesting tweet the other day by somebody that went and looked at all the 10K results of the major companies in the US. And it was interesting which company stood out when they used the word adjusted, or how many times they used the word adjusted in the earnings results or in the 10K reports. And there's a clear trend there. The companies that tend to perform the best kind of use the word adjusted the least. That's my next question. And then just the final question. I see you made the key strategic investment focus, the plant-based proteins and foods. That's a very interesting area for me. And I was wondering, I've noticed and I've seen the latest result of Beyond Foods in the US, their growth is kind of slowed, and they've got a lot of new competitors that they have to contend with. Given your focus in this area and I guess, investments into this field, have you looked at the recent trends and fast growth, it seems, of lab-based proteins and meats? I've been reading a lot about it, and it seems it's a fascinating area, and there's lots of focus there. People can't even taste the difference between egg white protein or lab-based chicken meat anymore. Just your comments in that regard, if you're looking into that, and if not, if your competitors are. Thank you.
Right, Albert, Miles Daly here. Thanks for those questions. Regarding this first one, which is the time period and the separate listings, what we have said is that we're going to bulk up the FMCG part of our business. We are actively looking at acquisitions in that regard, and we're saying we've resolved that we will have a separate chicken, sugar, and logistics business. What we're now going to do over the next while is decide how best we bring that to life. And there are a number of options, whether it's separate listings, whether it's joint ventures, whether it's disposal, whether it remains as it is, separate within RCL Foods and just managed differently. So over the next year, we will feed back to the market in each of those, and there may be different solutions for each of them. Regarding the recurring nature of the COVID costs and adjustments, fully agree with you, and that's why I said at the outset, really pleased that our statutory and underlying results are very, very close, and our adjustments are actually quite small. We probably won't make an adjustment for COVID next year. Last year it was a significant number, and that's why we highlighted it. And just to do a comparator, as you'll see, the COVID number is not massive this year, and a lot of it is in chicken, quite frankly. So we probably won't see an adjustment in that regard, and I certainly agree with you. The fewer adjustments, the better, but we do show both just to give the market an understanding of what our statutory unadjusted results are, and any adjustments, and be very transparent about what those adjustments are. We certainly don't just do adjusted earnings, so I agree with you, that would be inappropriate. Yeah, plant-based, if you take it one step back, we're actually talking about alternate protein, and agree with you 100%. There's a number of opportunities in alternate protein. Soya was the first, plant-based is one, and then following that is the lab protein. So ultimately, we are focusing very much in plant-based, and we've bought fries, so we have soya. And the Live Kindly IP sits very much in plant-based in the yellow pea. I have tasted chicken that's from a yellow pea, and you can't tell the difference or see the difference. You can with soya, obviously. So at the moment, our efforts and energies will be focused on plant-based. But yes, if you look at the big category, you've got to say it's alternate protein, and that doesn't mean in the future we wouldn't look at other areas within the alternate protein sector. Thank you.
Thank you, Miles. We're going to move across to our Q&A tab, where we've got a few questions loading here. The first one being, and I'm going to read the question out. You spoke about future growth baking plan. How many tons are you adding, and what does this mean for competition in the province? I'm going to hand over to Paul Cruikshank.
Thanks, Terence. So we've added an extra line in the Polokwane bakery, and I'm going to say reorganized our depot plan so that we put the depots in appropriate areas based on the location of that investment. There were a number of reasons why Polokwane was chosen, which doesn't necessarily mean all the growth will come in that area. We have already opened some depots in the eastern part of the Free State and in some parts of KZN, and we'll continue to use our existing footprint to move bread into those areas. And as I mentioned, targeting places or routes that Sunbake doesn't currently play in. So that's the one in terms of the baking plan.
Thank you, Paul. Moving across to another question. Could you also please comment on the sustainability of the recovery in the sugar business?
So I think let's just first contextualize F21, and Miles mentioned up front it was a record result for sugar. So we will continue in F22 to focus on what we can control. I mentioned crushing our crop is absolutely critical in sugar. You've got to get the basics right. We'll obviously extract what we can from our cane, and we'll continue our cost reduction or cost control program. One of the big impacts in sugar in the F21 year was the swing or improved local demand, so a swing between export sales and local. And we have continued to see strong demand in the early months of F22. So haven't seen a fall off yet in terms of demand. So if that stays like that, that'll help the F22 result. Industry redistribution based on production share is obviously critical. The full extent of that and the impact of the unrest in KZN at this stage is unknown, and we're busy working through that in industry. And over the next couple of months, we'll have more clarity as to the impact that it has had in KZN and the ability of the KZN-based millers to crush their crop, and also any crop destruction that did take place. So we don't quite have those numbers or impacts yet. Our sugar crop is expected to be down on the prior year. There were a number of factors which affected that. So whilst we see F22 still being a good sugar performance, it is unlikely to meet the performance of F21 and get to a more normalized result for what we would call a commodity category.
Thank you, Paul. Then we've got two questions from Kobus Saliers from All Weather Capital. The first one, Vector Logistics seems very well placed to continue to gain market share. Is this a function of weak competitors, superior service by Vector, or something else? Handing over to Chris Creed.
Thanks, Kobus. If you remember, there was a consolidation in the market, and Vector acquired the Imperial business in December 2019. So, sorry, their cold logistics business. So there was a consolidation of the market. We did gain market share. And yes, we would certainly like to think, and our reputation is for good service levels. So that's something we do strive for.
Thank you, Chris. The second question from Kobus is, secondly, on your baking division, can you please remind us on your hedging practices and when their hedges will roll over?
Yeah, so we take a different view on baking depending on what we see at the time. We are well positioned currently heading into the last quarter of the calendar year 2021. We obviously don't publish that, but we apply our own hedging practices and not necessarily just a standard practice based on what we see as a market read at any point in time. But we're comfortable with where we're positioned for now, despite the fact that in the last few weeks the wheat price has moved up quite significantly.
Thanks, Paul. Our next question, does bulking up the FMCG business include the spreads business, or are you looking at outside opportunities? Really needs to be substantial, otherwise you risk being a small medium cap with a small free float.
Yeah, good question, and agree with your sentiment, and that's why we say we're actively pursuing opportunities to bulk up our FMCG business. And at this point, I can't comment on which categories or which companies, but we are actively looking, and take your point that we need to ensure that we have sufficient scale within FMCG. Thank you.
Thank you, Miles. Our next question. Hi, good set of results, well done. Can you please explain the undersales in sugar volumes as if you're explaining it to a 6-year-old?
I'm going to do my best. It's always a tricky question. We do spend a lot of time on this discussion, but essentially this is to balance off the industry volume. So as we know through SASA, the volume, the revenue generated through sugar is distributed based on production share. So undersales will be if your competitors have sold more volume than you have in the local market, there is a rebalancing exercise which is done, and then that portion of the revenue is distributed appropriately between the different producers.
Paul, can I maybe add to that, because it's a very good question, and it is something that if you don't understand the sugar industry, it's very complex. Essentially, if you pool all the sugar and you've put in 1,000 tons and you sell 1,200 tons, you've borrowed 200 tons from somebody else. So what happened is other people in the industry sold more than they produced. We sold less than we produced. And so that is the undersell. And we then get a redistribution from SARS on that basis. Obviously, once you've got your tonnage, you then compete in the marketplace against each other, and you get the best prices that you can. And our team did a good job in terms of the mix and where and how we sold. And also, very important point, credit to Paul and his team. They did excellent work in our agricultural area and gathered a lot of efficiencies there, and we'll continue with that. And that's why Paul uses the word, we'll continue to focus on our controllables. Thank you.
Thank you, Miles. We now have two questions from Charles Bowles. The first one is, the separation plan seems unclear. Does RCL, excluding poultry, sugar and transport, have sufficient scale for a listing? Does separating out poultry and sugar into separate listings not just result in listings which are unlikely to be well supported?
Okay, going back to this question, similar to the previous question. So what we've resolved is that we're going to bulk up our FMCG business, and we are going to look at chicken, sugar, and Vector as separate entities. What we haven't resolved is what shape or form all of that will take. And so, as I mentioned on the call, we're going to take a very mannered and considered approach to determine what is the best option for each of those entities, FMCG, sugar, chicken, and Vector. And there are multiple scenarios that could evolve, but very mindful of all the points that are raised, and we're well aware of all of them. And so therefore we won't do anything that doesn't enhance shareholder value in whatever course of action we take. Thank you.
Thank you, Miles, and I trust that answers Charles Bowles' second question. Moving on to a chicken question. The question is, how close will you be working with Cargill? Some of these ABCD of grains trade for their own book, from what I understand. Is there not risk here? To Martinez.
Right, thanks, Taryn. So the cooperation with Cargill is, there are a couple of elements. One is a technical one. The other one, so that's to do with producing the best feed. The other one is just a procurement support. The decision and everything else lies with the local team, in other words, the Rainbow team. So we're not speculating. We are just trying to find the best possible forward points and decisions in terms of procurement. And it is therefore supported by Cargill in terms of the worldwide knowledge base on weather patterns, conditions, etc., all over the world. So that's where that support stops. And then obviously also in terms of funding the maize book, which will stand us in good stead on our own legs. So that is where that starts and stops.
Thanks, Martinez. We're just going to cross across to see if there are any more live questions that would like to come through. If so, please do raise your hand. Okay, we do have another question that's come through from Cobus Saliers. Are high shipping costs, shipping constraints, and port congestion giving you a benefit in the chicken and sugar divisions currently? How large is this benefit in your opinion? Martinez?
Yeah, I don't think there's a real benefit in there that we can see at this stage. It is true that shipping stuff around is more difficult, but so far I think the ways have been found to move chicken around.
Thank you, Martinez. We're going to cross over to, we've got another hand raised by LB Saliers. We're going to unmute you now.
Thank you. Just a question to Martinez. Hi, Martinez, and it's related to that cargo question. I didn't fully understand what Martinez was trying to say here, and maybe he can be a bit more clearer. I mean, firstly, I'd just like to know how many clients in South Africa, at least, does Cargill not support or is not Cargill clients? In other words, don't they have access to basically everyone's books? As far as I know, they are, support or give services to the majority of chicken producers at the moment, if I ask the latest ones to use them, as also to some of the egg producers. That's the one question. And then the second is regarding, Martinez said they're not speculating in the pricing. Now, that can only be true because everyone says the same thing. And, every year you see, losses or not on the procurement of maize or feed, soy. You can only not speculate if you buy every day your needs. Any other strategy that you have in place, you take a view on whether, as Martinez has shown, or, supply and demand. I mean, in effect, you take a speculative view of where prices are going to be, or what the weather is going to be, or what the supply is going to be. So you have a strategy. Every producer do it differently. Some producers say they buy every 2 months their supply. So, as an analyst, as an investor, you can look at the price graph and say, the company is buying every 2 months, what they need. Then you don't speculate. You have a fixed policy. Anything else, when you take a view, you are speculating on price or something else. So I just like your view on that piece, how you do that. Thank you.
All right, thanks, Alvin. Firstly, Cargill is one of a number of multinationals supporting, various players. So they're not supporting all players. I wouldn't like to say who else is using whoever, but there are a number of multinationals. And I think it's a matter of every year evaluating who provides the best, basis and delivery charges. So they can not only they can't just focus on trading for you, they have to physically also deliver your maize. And I think that's, that's an important point. First thing we have to do is mitigate the risk of, having feed for your chickens. So you cannot merely sit and speculate and go ahead, and not buy, etc. You may have to participate in the market to supply your chickens with feed. In terms of the definition of speculating, I think what I'm implying is we have very specific procurement rules that we abide with and abide by, and obviously we can't just go, extremely long or extremely short, but you have to use the tools at your disposal. And the object, obviously, is to procure as best as possible, because 70% of the cost to grow a chicken is linked to feed, of which about 60% is maize. So the better you have a view of what is happening in the world, and this year we've seen that the price of maize had very little to do with local conditions and the local crop, but all to do with international impacts, whether it's China's, demand or weather patterns abroad. So the better you understand those, it trades, the market trades a lot on sentiment, etc. The better you understand that, the better decisions you can make and the less guessing you have to do. The decision is always one where we get all the inputs from whoever we consult with, and then we make our own decision. It has to be our decision. Hope that helps.
Thank you, Martinez. We've got a question from Chris Logan. It sounds like your strategic review has had a pivotal impact on the group. Would you agree with this? And is the strategic review assignment ongoing, or has it now been terminated? I'm going to hand over to Miles.
Yeah, thanks, Chris. I think that's a fair observation. It has been pivotal, and that's why we also wanted to spell out clearly what we've resolved. And that is, as I've said, the FMCG focus, investment, bulking up, and finding the best destination for sugar, chicken, and Vector. So really you can look at the assignment being in two phases. The first was to resolve what we were going to do, and the next 12 months we will continue to work on this, of where we're going to end up and how we're going to do it. And as I was saying to an earlier question, what is the best answer for each of those entities within RCL, mindful of all the comments that have been raised and the pitfalls that we've got to avoid. Thank you.
Thank you, Miles. If we can unmute Charles Bowles, he's got a live question.
Morning.
Thank you, Charles.
Thanks. Thanks for the presentation. Miles, not to beat this to death, but several years ago when you acquired the FMCG and sugar businesses into Rainbow, I asked the question, it looks like you're reconstructing HLH, which, albeit probably at a lower quality, because Robertson's was arguably a better quality business than your FMCG business. And you said, and why did you feel comfortable that you wouldn't have a repeat of HLH? And your sense was, this time the businesses are being integrated and that will drive value. So with that in mind, I'm unclear how easy it is to unintegrate them, if you will, and to separate them. And secondly, this issue of the right home for these businesses has been it feels like a 10, 20-year journey. And it's hard to get comfort that there is clearer thinking now than there has been over that very long period of time. And I appreciate there's not an easy answer to this, but you are, fundamentally you have businesses that the market is unlikely to want to see listed. And, separating them conceptually, it seems fine to say, let's separate them. The practicality of doing that has been elusive for years. And maybe if your sense as to why you feel more confident this time than you have in the past. Thank you.
Thanks. Really good question. Yeah, pleasure. Really good question. And yeah, you're right. I mean, obviously with my history, having sat on the HLH board and being CEO of Robertson's for 8 years, I was very aware of what I personally thought were the issues with HLH being not integrated. We did, I think, a great job at integrating the business, and we've created significant capabilities within RCL Food, and that's the platform that we refer to. I think evidenced in two very clear ways. One is when we took over the Sequalo business, i.e. the Unilever margarine, from Unilever and ran it on behalf of Remgro, we were able to bring it in at a very low on cost to us, but still charge a market-related fee, which has been really good for us. And we've actually improved the spreads position from what it was when Unilever managed it. And we have Kees Kreethoff, who sits on our board, who was a very senior executive in Unilever Worldwide, and also the ex-CEO of Unilever South Africa. And he was incredibly impressed with what our team has done. So I think that the integrated nature of our business has had enormous benefits. And our front end is a prime example in terms of the strong front-end capabilities we have within RCL Foods. In terms of having then going forward, what we're saying is that you're right, the market doesn't like and the shareholders don't like the composition of the companies and the brands that we have within our organization. And therefore, we've taken that on board and we've done this review and we've been clear on what we see as the outcome of that review and the direction that we're going to go in over the next while. Quite frankly, it is quite easy. We've managed to separate chicken out as a separate legal entity in a couple of months, with under a year. And we're in the process in the background of doing that with Vector and Sugar and the FMCG businesses. So our team is well versed on putting things together and separating things out. Just going back, the second example, I said there were two. One was the margarine business. The other was Live Kindly, again, chosen as their partner because of our capabilities with customers and brands and operationally what we can do in South Africa. In terms of a home for each of those entities and whatever that home may end up being, we actually clear, and just we can't always talk about things until we're able to talk about them, but we're reasonably clear that there are a number of options for all three of those, and we're not talking a 20-year journey. We're talking a 2-year journey. And things will happen as and when we think they're appropriate for each of those entities. But we've been very clear, I think, in our statement in this presentation about what our intention is, and very clear that we're going to do it on a considered basis over the next 12 to 18 months. And that's the kind of time frame that we're looking at. Thank you.
Thanks, Miles. We have another live question from Erica Hoffman. We're going to unmute you now. Erica, if you can unmute yourself. There we go.
Sorry, it was a mistake. Sorry about that. I lowered my end later on.
No problem. Thanks very much. We do have another question that's come through on the Q&A tab on Vector Logistics from Cobacilius. I see Lancewood is a new customer. Can you share how Vector and Libstar are working together, and if there are other businesses with Libstar that Vector services?
Thanks, Curvis, for the question. Yes, we took over the Lancewood business when we took on the RCL principles in December 2019, and that remains a very good integration and customer for us. And that's about the extent of our interaction with the Libstar group is through the Lancewood business.
Thank you, Chris. We do have another question that's come through on the Q&A tab around chicken. It asks, given the poor second crop in Brazil, Brazilian domestic chicken prices have risen a lot. Are you seeing this in import prices landed in South Africa? Martinez?
Thanks, Darren. Yeah, it is a good question, and we obviously always observe what's happening out there. But I think, unfortunately, the nature of particularly the dark meat products is that it is a dumping process. So the cost of production has very little, if anything, to do with the price that is on offer in terms of imports. That's why, obviously, it's very hard or impossible to compete with. So, no, it was always a matter of surplus and resolving surplus in markets that, like ours, that like the dark meat product.
Thank you, Martinez. We're just going to turn across and see if there's any other live questions to come through, if anybody would like to raise their hands. No, there are no live questions, no hands up for live questions, and there's no further questions on our Q&A feed. With that, I'm going to hand over to Miles for a closing.
Yeah, thank you, Taryn, and thanks all for listening in. And as we said at the outset, we are really pleased with the results that we've delivered, and we're very clear about the way forward. And I would just like, from my side, to thank you all for the support over the last 18 years. It hasn't always been easy, but I thoroughly enjoyed my 18 years and working with yourselves. And as I said a little earlier, Paul, to you, all the best. I know you're going to take this business from strength to strength. So thanks, everyone. Cheers.
Ladies and gentlemen, that concludes our webcast. Thank you for joining us. You may now disconnect.